So just so you guys know, there are three types of stablecoins primarily. Now we might see some more in the future, but it's kind of hard to conceptualize right now. So the three types, you have crypto collateralized, and that could be under or over. So that's under collateralized or over collateralized. You have fiat collateralized, same thing, it could be under or over. And then you have non-collateralized or algorithmic. And so you could probably give a better example. The example I'm thinking of is Basis. I don't know if Basis is still around anymore, but they use a bond mechanism to determine the supply, basically, and it's just all algorithmic. There is no backing on that stablecoin whatsoever. I don't even know if they still exist.
Yeah, so it's like you actually see in the same parallels with the types of stablecoins. Like you have Maker, which issued the DAI stablecoin. And back in the day, or even still now, the only way to get DAI, so like all of the circulating DAI, came from people locking Ethereum into a vault and then withdrawing stablecoins, almost like an over collateralized loan, withdrawing DAI from that vault. If you go on DeFi Llama, you can see that Maker is of the top TVL, and it makes sense because their stablecoin is so large. But now, if you look at Maker's backings, they're holding a lot of like the same things that USDC and USDT is holding: short-term notes, treasury bonds, commercial paper, all these types of things. So like in the beginning, people are always like asset backed, gold backed, da 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 da. But they realize that that's just not a sustainable model, and you need an elastic currency, because that's the only way it can work, and that's the only way it has worked. And then in regards to algorithmic stablecoins, the logic behind that is the supply and demand controls the supply. So like, for example, we've all seen times where in the bull market, when things are going crazy, you see the price of stablecoins break its peg to the downside because the algorithm can't keep up with the volatility all the time. So people are selling. Remember, we said stablecoins are a way for people to get on-ramped into crypto. Once people are selling their stablecoins for altcoins or Bitcoin, you see the stablecoin drop because the supply increases. And then once people are buying stablecoins in bear markets, you see the price rise because people are buying them more.
And it's funny. So what you described, I think that would apply more to asset-backed stablecoins. I think with non-collateralized algorithmic coins or tokens, that response would be a lot faster because it is a coded monetary policy. So even if you think about how our monetary policy works as a nation, there's always going to be a lag. So in a asset-backed stablecoin where you have to rebalance, you have to, whatever you have to do, that's going to take some time.
Manual rebalancing.
Manual rebalancing, yes. Now, on an algorithmic stablecoin, I mean, anybody would safely assume that it's going to be a little more autonomous in the way monetary policy is carried out. And so decisions based on the algorithm should happen in a snap.
By the way, the decision that's being made, so in the bull market, when the price of the stablecoin would drop, in order to control the supply, the algorithm will burn the stablecoins. And when we're going to a bear market and people are buying stablecoins, the algorithm will mint new stablecoins to keep the peg.
Yep, 100%, 100%. And obviously the goal is to stay one-to-one with the assets, but that never really happens. It always breaks at some point. So yeah, those are the three types. Now, the first iteration of a stablecoin was actually BitUSD in 2014, and that was in July, not too long after you had Tether. But BitUSD was the first crypto-backed stablecoin. I can't remember exactly what crypto they held as a backing, but it's a reason it didn't work. The volatility is pretty insane if you're only backing it with crypto, and you can guarantee that they were extremely over collateralized, probably by 150, maybe even 200% back in the day, just to be safe. And so a couple months after that, obviously Tether, they were taking notes from those guys. Tether came out and they were more fiat backed. And so they use commercial paper, which we'll go through at some point here. They use commercial paper, they use dollars, they use treasuries, they use short-term bills. They use anything that is like cash equivalent or cash. So that way, they won't ever run into the issues that BitUSD has run into. And also, you don't have to over collateralize to own Tether because it's a one-to-one backing. So for me personally, like I've never been a fan of, well, I've been a fan, but I've never been a huge proponent of Maker and DAI, just because when you make it that complex, it's that complex for a reason. And when you have to over collateralize, that just introduces way more risk than, I mean, it doesn't make sense for you to choose that stablecoin over another stablecoin unless you're looking for yield generating opportunities specifically, and it happens to have a higher yield generation at that moment. That's the only time it makes sense. Other than that, if you're investing into any stablecoin trying to earn yield, and they're both kind of similar in the results or outcome, it makes sense to go for something a little more streamlined and a little more concrete in its makeup. Because you never know when it comes to code and monetary policy. Something could happen to where there's a mass liquidation. You guys probably heard of network value settlement, which MakerDAO has implemented. So if that happened, which it hasn't happened yet, so that's good. But if that happened, it could wipe everyone out, it could liquidate without you knowing or wanting to. And yeah, just introduced a whole swath of risk that me personally, I would like to stay away from. But that's just an opinion right there.
All right, guys.